Commercial valuation HMOs are the current buzzword, but in my opinion, they are doomed to fail. Trust me when I say the commercial valuation route is an incredibly powerful strategy for growing a property portfolio. I have spent many hours with awesome property investors that are executing this strategy to a T. This video is absolutely no hate towards them. In fact, many of them I really admire. But what most people don't realize is that a commercial valuation can be a blessing or a curse depending on the deal, your lender, and your long-term strategy in property. So in this video, I'll break down the pros and the cons of commercial valuations, when I think you should use them, when I think you should avoid them, and how to make sure you're not left holding an overvalued asset. So first of all, let's just make sure that we are actually on the same page when it comes to commercial valuations. Some of you might be thinking, what is a commercial valuation? How does that differ from a typical property refinance? Well, to answer your question, there are two main ways that a HMO can be valued. Number one is bricks and mortar. A bricks and mortar value is basically a valuation method that is based upon comparable sales of similar houses nearby. So if other 6-bedroom houses on your street are worth, let's say, £300,000, that's roughly what your property will be valued at. If you're buying a property in that road and it's currently only 4 bedrooms, well then you need to factor in the cost of refurbishing and converting it into a 6-bedroom HMO, then plug that into your deal analysis spreadsheet so that you can determine the price that you can pay for that property without overpaying for it. Number two is commercial valuations, which is obviously what we're talking about today on this very video. Commercial or investment valuations are based on the income that a property produces. So the asset is looked at like a commercial entity. The valuer goes round to the property, they look at the total rental income, they deduct the expenses, and then apply a yield, also known as a cap rate, to work out what the property is worth as an income producing asset. To give you an example and to explain this in a bit more detail, if the gross income of the HMO was £40,000 per year, the valuer might apply a percentage of costs to that income, e.g. let's say 25%, meaning actually that the net income of that property is then said to be about £30,000 with that included. So if our gross is £40,000, we deduct the expenses, our net income is now £30,000. If the local yield in that area is said to be about 10%, then what happens is the £30,000 is divided by 10%, giving a value of £300,000. That is what the property is believed to be worth. Now, if you can actually justify a lower yield in that area, let's say 8%, then we do the same calculation, obviously dividing the £30,000 by 8%, and that's actually going to give us £375,000 as the property end value. Seems pretty amazing, right? So why would I be saying that commercial valuation HMOs are doomed? Why do I not just go and do this strategy myself? All right, well, let's start with the good stuff, okay? Let's start with what I call the pros of commercial valuations. The first one is that it rewards great design. If you've increased the rent of your property through better layouts, en suites, or by targeting professional tenants, that's directly reflected in the valuation of the property. By the fact that more rent equals more annual income and the multiplication leads to a higher valuation. You're being rewarded for creating extra value, not just waiting for the market to rise. And you'll often see investors creating these incredibly luxurious, high-end HMOs, and you might think, why are they going so high-end? It's a HMO. Well, this is the answer. It's to push up the rents, which means they can push up the end value. The second one is that you can pull out more money. This is a big one because the property's value when it comes to commercial valuations is based on the income and not the comparables in the road, meaning that you can often refinance at a higher value and recycle more of your cash out of the deal. or even all of your cash out of the deal. Over the years, I have personally come to realize that securing the right property deal is more important than leaving in as little money as possible. But with that said, it can't be ignored that leaving in less money in a property is always an exciting prospect, and commercial valuations allow exactly that. And this point also leads me into my third point, which is commercial valuations allow scalability. For investors building portfolios, scalability is key, and commercial valuations let you recycle your funds and keep moving on to the next deal faster, rather than tying up too much of your money and being stuck waiting for slow capital growth. And as the last but not least, it can attract higher end lenders. Now, some specialist lenders look at income and experience, not just the property type, which can open up better rates or better terms for professional operators. It is good to have a network of these lenders to be able to call upon for your portfolio and for your properties. But let's not get too excited just yet, because commercial valuations are not always a good thing. The first reason I want to highlight is exposure and risk is high during these types of projects. Often I have seen investors secure properties at market rate. When I asked them, why didn't you aim to get a discount on that property? They said, well, we don't need to with commercial valuations. We can just go out, buy a property off the street and add value. The end valuation pays us back, so we don't need to spend time securing a discount on a property purchase. And this just seems like nonsense to me. In my opinion, being a good property investor involves buying stock, buying properties at the right price, not overpaying for them because you're guaranteed to get money back at the end. The second reason is, well, lenders can down value. Two different valuers can look at the same HMO and come back with numbers £100,000 apart. The speculation around room rates and calculations used can be so different. There's a level of subjectivity involved with it, and wherever there's subjectivity, there is a level of uncertainty, especially if you're relying on that high valuation to refinance and pay off that high refurbishment or high price that you paid. Just because an agent or a broker have said that this might get a commercial valuation doesn't mean the lender will agree. Some lenders will actually default back to brick and mortar valuation if they don't see the evidence that it's a true HMO business, which can be if it doesn't have enough rooms or it doesn't have enough en-suites and it isn't deemed as a commercial property, basically. The next one is that you are exposed if the market yields change. And what do I mean by this exactly? A lot of investors will purchase properties that are close to universities or close to city centres, and quite rightfully, because the demand for room drives up the rental prices and therefore the end value of the commercial property that they own. However, if the market softens or rental yields go up in that area, your commercial value can actually drop rapidly. Remember, this is an income-based strategy. So if your rooms are empty or they drop in price due to condition or due to there being less demand, then your valuation of your property can tank overnight. With this in mind, brings me on to my fourth point, which is it can make selling the property harder. And this has to be my main concern with this strategy. You see, when you go to sell this property, the vast majority of buyers in the market aren't specifically looking for commercial HMOs, meaning that your market is very niche and it's very small. Not only that, but if the investors that are interested are actually any good at what they do, then they'll likely want to secure a discount on the purchase price. Meaning that A, you might find that most buyers don't want commercial property. They want to buy stuff which is residential bricks and mortar value, so that when you sell this property, you'll be selling it at bricks and mortar value, even if you've refinanced it at commercial value. And B, they are likely to want to purchase at a discount. Who makes up that downfall or discrepancy between the prices? Well, you do, the person that owns that commercially valued property. So long term, I think that it's really important that investors have a reasonable exit strategy or some kind of long-term exit plan. And number 5, it can backfire on refinancing. This somewhat ties into my points just before, okay? If your property's commercially valued at, let's say, £400,000 today, And then 5 years down the line, the next lender only calculates its value at 300,000 because of some of the problems that I've mentioned in this list of cons, or because of changes within lending. Well, then you could struggle to remortgage this property without injecting extra cash into your business. So once again, you are left to make up the downfall. So that is the pros and the cons. Here is my overall opinion. Commercial valuation HMO is a great short-term strategy for relocating capital around quickly, project to project, and building up cash flow. It comes with massive risks when doing the project because the costs are high, but you can get money out at the end. And then it comes with more risks further down the line when it comes to selling or refinancing. And with that in mind, its long-term prospects are a bit bleak. It relies solely on the market continuing to grow in terms of rental prices and in terms of property prices. If you want a reminder of why, having properties worth 200,000 in a road, yet one of them is valued at 350,000 pounds due to its commercial value is complete nonsense, and it's a recipe for disaster. And I've seen much worse than that. I've seen roads where the end values are 500,000 and there's commercial HMOs being refinanced at 750 to 800,000 on that road, which again, just doesn't make good long-term sense. So here's why I stick to the basics in 2 short points. Number 1 is there is constantly a change of regulations when it comes to any strategy outside of the norms. Serviced accommodation has experienced lots of changes over the years, and now HMOs, okay? Taking it away from commercial valuations specifically, there are continuous changes around HMOs, around the regulations, around where and what landlords can do with the HMO strategy. Obviously, that will have a direct impact, particularly if your property is valued off of the basis of what your property earns and not the bricks and mortar. The second reason is, for me, buy-to-let and flipping properties might face some of those changes, but they are more permanent strategies. Feel free to prove me wrong or disagree with me here, but buy-to-let and flipping properties are strategies that I believe will be here in 5 years, 20 years, 50 years time. And I believe the art of buying properties for low market value, adding value, and then either refinancing or selling, well, I just don't think that is going anywhere. I think that's a strategy that will continue on, and therefore I like to keep it simple and I like to keep it slightly less risky, and that's what I'll continue to do. I'm interested to hear your thoughts on commercial valuation HMOs. Do you think they're good? Do you think they're bad? Are you going to do this as a strategy, or is this something that you will avoid? Drop me a comment below, and of course, I'll see you in the next video.